Can the Fed normalize interest rates, which I would call about 2.5%, and normalize the balance sheet, which I would call around 3 trillion, without causing a recession or a stock market crash or both? The answer is no. One point that I would make is that when you say this is the highest inflation since 1982, 40 years basically, that's true. But the inflation in 1982 that we're comparing it to was the end of the inflation. It started really in a severe form around 1976. And so by 1982, it had come down to 7.5% or thereabouts. So you're right about those numbers, but it was up to 15% in 1980. So 7.9 or whatever the last number was in terms of the monthly inflation figures, yeah, that's pretty bad. But don't think it can't go a lot higher. It can. What I expected, and I still expect this. Let me put it this way: I still expect this, but I pushed out the time horizon because a lot has happened and we have more data. There are two kinds of inflation. And one is what they call cost push inflation. The other one is demand pull inflation. Those are economic jargon. But demand pull is when it's driven by the consumers, the everyday American or everyday person around the world. They see some inflation. They go ask the boss for a raise. They go, hey, I need more money to keep up. They accelerate purchases, like, oh, gee, if that refrigerator is going to be more expensive 3 months from now, maybe I better buy it today before the price goes up. It kind of feeds on itself, but it's very much driven by consumer behavior, the behavior of labor and working people. The other kind of inflation is called cost push. That comes from the supply side. That basically is, an oil embargo or a war in Ukraine or economic sanctions or supply chain disruption. It could be a lot of causes or multiple causes, but basically it's not that the consumer has so much changed his or her perspective, but they can't get stuff, or the suppliers are raising the prices because, hey, our input prices are higher, so we have to raise the prices to consumers. Now you can have both. One can feed. It can start as sort of cost push, meaning it starts with supply chain disruption, comes from the supply side, but then the consumers say, "Hey, no mas, enough. I want to raise," and so it can feed on itself. The reason I make that distinction is because the Fed can possibly do something about the demand side. The Fed can squash it by raising interest rates and raising mortgage rates and deflating asset values, et cetera. The Fed can't do anything about oil. The Fed can't do anything about the supply side. They maybe people think they can, but they can't. So right now, this inflation has come from the supply side. Now, how will it play out on the demand side? That's the question. The Fed has exploded the money supply, so there's no question about that. M0 has gone up by 400%. The Fed's trying to rein it in a little bit, but when you go from 800 billion in 2008 to 4.3 trillion in 2013 when they started the taper to 7 or 8 trillion, which is where it was after the pandemic in the spring of 2020. There's no question about the money printing, but that money doesn't go anywhere. It doesn't do anything. It's basically the Fed expands M0 by buying bonds from the banks. They take the bonds on the portfolio. They give the money to the banks. Money comes out of thin air, but the banks just give it back to the Fed as a deposit in the form of excess reserves. So you're inflating the liability side, which are the excess reserves, and the asset side, which are the bonds. You've inflated your balance sheet, you've increased M0, but you haven't done one thing for the economy. There's nothing about what I just described that goes into the real economy. Now, where does money for the real economy come from? It comes from commercial banks lending and consumers spending, and that shows up in velocity. And if you look at the velocity statistics, they've crashed in the last 10 years and they're still going down. So the reason so-called money printing doesn't turn into inflation is because the money doesn't go anywhere. Gas prices are going up. We all know that. They've practically doubled, more than doubled. But people need to drive. There's some discretion, but you got to get to work. You got to visit the relatives. You're out there driving. So you don't have much choice about it. You just have to pay it. But that reduces your discretionary income. It means you're not going to buy something else. You're not going to go out to dinner. You're not going to buy a present. You're not going to buy a new TV set. There's some other thing that you're not going to buy because you had to spend more at the pump. And that would not be true if real wages are going up, but real wages are not going up. So monthly we get the employment report, and it's been showing that Real wages went up, or sorry, wages went up, let's say 5% on a year-over-year basis, and that's about what they've been going up. Everyone say, look, wages are going up. No, because that's 5% nominal, but we just said we have 7.5% inflation. So when you subtract the inflation from the nominal, real wages are negative. They're going down. So price at the pump is going up. Real wages are going down. People are miserable about that. The way people adjust in the real world is they stop spending on something else. So that can slow the economy. We're seeing it already. Atlanta Fed GDP numbers have been quite low. I'm not forecasting a recession, but it wouldn't surprise me. We're seeing yield curve inversion, not just in the
Yeah.
Treasury yield curve, but look in the Eurodollar futures yield curve in the reds actually, which are not that far out. That should never be inverted.
So
That's like one of the clearest signs of a recession you can find. October 1st to December 24th, 2018, the stock market crashed 20%. That's because, and then what did Jay Powell do? He stopped rate hikes. He stopped. They started a new taper, new QE6 or whatever at that point, and he cut rates. And then we went right into the pandemic, and rates are back to zero, and the balance sheet tripled. So he failed, and the stock market crashed in the process. So now we're doing it again. But Wall Street, it's not going to take as long to play out because Wall Street has seen this movie before. So here's the thing. This is your question. Can the Fed normalize interest rates, which I would call about 2.5%, and normalize the balance sheet, which I would call around 3 trillion, without causing a recession or a stock market crash or both? The answer is no. But the problem with the Fed is they're usually the last to know. Like I just told you, you get it. The viewers get it. But Jay Powell will be like the last one, other than some of the other governors, to understand what we just said. And so we'll probably get the recession and the crash before the Fed gets the wake-up call. But no, they can't do it. As of this minute, based on all the information we
okay.
have, it's hard to predict, although it's very likely. We're seeing a lot of signs that could be true. But as the Fed goes down this path, then they will cause a recession. That will absolutely happen. But whether it's late this year, early next year, or it could be sooner based on. See, now here's where it gets a little more complicated because the economy, the global economy, and the U.S. economy would be slowing drastically anyway because of the sanctions and the economic war with Russia and energy shortages, etc. That would be happening anyway. The Fed has got a quadruple tightening exercise going on. So they just tapered. So that's one. They just raised rates. That's two. They previewed the fact that they might actually reduce the balance sheet. That's quantitative tightening, or QT. That's three. And then in the last dot plot, even though the dots are kind of a joke, said that they would have more rate hikes sooner than people expected. So that's a quadruple tightening.